Hi, good morning. My name's Renee Berman, and I'm thank you very much. My name's Renee Berman, and I'm excited to be here this morning, and thank you very much to the TIE for hosting this event. I am a managing director at DTCC in our digital assets group, and I'm really excited about the opportunity to talk to you about how we can capture the $16 trillion opportunity that exists today. We're going to switch gears a little bit, from focusing on crypto to really focusing on real-world assets. So before we start, I did want to give my panelists the opportunity to introduce themselves as well.
Thank you, Renee. Hi, everyone. Good morning. My name is Matt Zhang. I'm the managing partner and founder of HiveMind Capital. We are the Web3 digital asset-focused investment firm, headquartered in New York with offices in London and Hong Kong. Before I launched HiveMind in 2021, I spent about 15 years in Citigroup. I was their global head of structured trading and focusing on asset-backed securities, securitizations, and mortgage lending.
Hi, I'm Mitchell Dong, and I'm wearing red for a reason. Um, I'll tell you that in a second. But I run Pythagoras, which is a hedge fund that trades quantitative, systematic algo trading of crypto. We have a 10-year track record, 100 million of AUM. But I'll tell you why I'm wearing red. I think that Trump election is great for business. It's great for crypto. Our funds are up like very high numbers today. But I think it's a sad day for investments in healthcare, investments in education. It's a sad day for women. It's a sad day for investments in environment and fighting climate change. But we're making record profits, and it's great for business. So I don't know. Anyway, that's my introduction.
I can't top that, I'm sorry to say. Roger Baston, I head digital assets for Franklin Templeton. Many of you may know us for our flagship product that does use blockchain piping. To follow up on what Mike was saying before, Benji, our tokenized U.S. government money market fund, which we're actually perpetuating around the globe. So it's really great to be with you here today to talk about tokenization of more types of assets.
Hi everyone, I'm Charles. I'm in charge of structuring of digital assets for Société Générale, which is a French bank. We started on tokenization several years ago in Europe, issuing bonds and structured products on Ethereum. So public chains, which is we're probably one of the few financial institutions to work on public chains. And we more recently issued our own Euro stablecoin in Europe under MiCA. And I'm very happy to be here to talk about tokenization.
Thanks so much. So at DTCC, one of my roles is thinking about how we can leverage blockchain technology to reimagine what we're doing, and also internally, and then also work with clients to help them reimagine how blockchain will revolutionize our world. In this capacity, we talk about how we can increase adoption all the time. Last year, we issued a white paper in collaboration with Euroclear and Clearstream that actually focused on this exact issue. And then earlier this year, to help the industry industry adoption, we issued a set of digital asset security control principles, a risk and control framework that has been downloaded over 40,000 times. So clearly there's an interest in the marketplace, to help with adoption. I'm sure most people in this room have seen 16 trillion as the opportunity that BCG put out to basically reach 16 trillion by 2030. We've seen different numbers. McKinsey's number is more around 2 trillion, and I've seen other ranges. But regardless, this is a huge opportunity for the marketplace. So today we're going to talk about what are the benefits of tokenization of real-world assets, and what are the challenges that the industry is facing to help us reach that target. So I'll turn it over, Matt. What is your perspective on what some of the benefits are?
So despite I was running the securitization at Citi for many years, which is RWA, is a fancy word to say the same thing again. I was actually pretty bearish initially regarding this. The reason why it is when you're trying to challenging an incumbent, an asset class that's been there for many years, off-chain, offline, it's very, very hard to change infrastructure. I have many friends in the space in the last few years and trying to do many things. And kudos to the securitize or circle in different ways, really trying to change the space. And I think what happens yesterday on the election, forget about sort of what actually ends up happening in White House. I think from a regulatory legislation standpoint, hopefully we're really trying to propel the space forward, because RWA or tokenization has a real benefit if you be able to have a mass adoption impacts across the board. Transparency, data integrity, efficiencies. I think all the people here probably know all of this. I think the benefits is probably not needed to keep getting repeated. I think the question is about where the real demand is coming from, where the execution is coming from, and what type of regulation and legislations you need to really helping this pushing forward. I mean, we were debating and discussing this 2 weeks ago. The issue when a new technology coming in normally is the technology has to be 10 times better, not 10% better. If it's 10% better, when you see a downturn in the last 2 or 3 years, what we saw in digital assets, it's very easy. People are moving away from it, pausing there, because the benefit is not just enough to be able to replacing all of the headaches and costs and sort of the disruption you have to go through. But generally speaking, I think if we be able to making sure we're getting this done with the right, clear regulation framework, I think that's obviously going to be a huge impact.
And then Mitchell, you're primarily an investor on the crypto side, but how do you see the market for real-world asset tokenization playing out? Like, what do you see as the opportunity there?
So before I was in crypto for 10 years, I was in oil and gas and energy trading for 25 years. So what our company is trying to do, one of our projects, is to tokenize physical oil and then move on to natural gas, uranium, copper, lithium, and other energy commodities. The plan is to secure the oil from the majors and then put the title of the oil that we secure on the blockchain, and then plan to list it on the major crypto exchanges like Binance, OK, Gate, and others. I was at the Binance blockchain conference last week in Dubai, and I talked to a lot of crypto traders who in Dubai, many of them also trade oil. And we want to give the opportunity for users on the crypto exchanges to trade oil in a digital format, in a crypto native way. And I spoke to TradFi oil traders and presented this opportunity, and they see opportunities to do market making and arbitrage with crypto oil traders. Furthermore, on the purely blockchain side, physical oil trading, I'm not talking about futures, but physical oil trading is a very paperwork, opaque, and not terribly liquid. Even though oil itself physically is liquid, it's not a terribly liquid market. So we're trying to bring the benefits of blockchain, faster, better, cheaper, to physical oil trading. So oil is basically $100 trillion market, and if we capture 1% of that, that's $1 trillion. It'll make a dent into the 16 trillion.
Right. And Roger, maybe talk to us about what some of the benefits of some of the investors in the Benji Fund are seeing.
Yeah, I probably have something that's a little bit more practical and less aspirational than my fine gentleman here have spoken to. And that's because when we decided to use a public blockchain environment to house the transaction records for a security, Benji is is the most boring, plain vanilla U.S. government money fund underneath. But when we start putting it on chain, the transaction records on public blockchains, now we unlock features that previously have not been available. Practically instantaneously settlement between two parties is what we're doing currently on Benji. If you are a customer of Benji inside of our walled garden, you can transfer Benji back and forth practically instantaneously. And in short order, after you transfer, you're going to start being able to receive interest, intraday interest, rather than waiting on a 24-hour cycle. So literally, we've taken what is the most boring product on the planet Earth, a U.S. government money fund, bringing it onto these public blockchain rails, unleashing massive amounts of utility that will actually be used by these two gentlemen, hopefully, as collateral inside of the markets that they're trying to create for these other physical real-world assets. And so I think that's a real practical implication of why you want to explore these technologies and apply them even on things that are not necessarily aspirational to come, but things that are used every day. There's literally trillions and trillions of dollars all over planet Earth in money fund constructs, by and large. And we're just upgrading that environment for the new economies, the new opportunities moving forward. I think that's a real practical application that is not so much aspirational, but something that's happening right today because we're using these public blockchain environments.
Great. And Charles, tell us about what SG Forge is doing to help drive benefits to your clients.
Yeah, so we see advantages around basically three pillars. So of course, of operational efficiencies. I mean, working for a broker dealer here, one of the things I discovered not so long ago is trace reports. So basically, we need to report all of our transactions in the US to our regulators. And tomorrow, if everything's on blockchain, we don't need to report this trade. They are automatically visible and directly accessible by the regulator. So that's, and you can't imagine the difficulty of putting this kind of reporting systems in place to capture all of our transactions on various assets. So of course, operational efficiencies. Then of course, risk, diminution of risk, reduction of risks. So DVP is fine, but you can't find DVP on any kind of RWA. I've been working on carbon credits for a while, and reducing counterparty risk on carbon credits is not that easy. Tomorrow with tokenization, of course, you can automate everything and reduce this kind of counterparty risk. And of course, business development is the third pillar in terms of distribution, but as my colleague said from Franklin Templeton, also new features in the products themselves. So you can get intraday interest, you can get new kind of options within your products. Let's take very basic structured products that pays a fixed rate. You can embed like an option to switch from a fixed rate to a floating rate at the hand of the investors. That's something that is very hard to do today in financial products. So of course you can unlock a lot of these features by, I would say, connecting directly the investors with the issuers of the products.
Thank you. So I looked yesterday and on rwaxyz.com, and it seems that the total amount of tokenized real-world assets is 13 billion as of yesterday. How are we going to go to 16 trillion in about 5 years? And what are some of the challenges that you're seeing in the marketplace, and how we can work together to address some of those challenges? I'll actually start with Charles at the other end.
Yeah, so of course you need to offer, I would say, a better experience or a better price to clients if you want to develop these products. Today, we are pretty far from that. People have very heavy systems in place. So you come to them, you offer a new framework, a new infrastructure. It doesn't necessarily fit their accounting or tax systems. It's a bit difficult for them to integrate these new products. So we do have to do much better on that aspect for clients to be, ready to invest more in digital assets. But of course, there is the regulatory piece. And when we started in France a few years ago, we did have a specific law that allowed us to use blockchain to register the ownership of assets. And that was, I would say, a key support for us to go and discuss with the clients. And here in the US, it's still a bit of a gray area, whereas we can use public chains, or what are the restrictions around that. And one of the key elements from my perspective is the transferability of the assets. And until we reach that, I would say free, not necessarily free transferability, but easy transferability on chain, we are probably going to stay on a pretty small environment, meaning everyone will have developed its own walled garden. You can interact between a very few parties, but you need to open the gates and being able to transact with, I would say, properly KYC parties, but on a bigger field. And that's, I said, one thing which is missing today.
And Roger, what do you see as some of the challenges that Franklin Templeton is facing, or the industry is facing for adoption?
Well, for adoption to hit the type of estimates that we see in some of these studies going forward, I think what you need is just massive proliferation of blockchain-enabled digital wallets. Legacy, investment firms, broker-dealer platforms in the United States don't yet have those integrations, yet, blockchain-focused, crypto-native, crypto exchanges have literally hundreds of millions of those type of users and those type of wallet infrastructures. I think some of the promise, at least in the U.S., that we'd like to see moving forward here in a more favorable regulatory environment is those two worlds coming together in a larger, more substantive way. I mean, we came to understand, just as a user of public blockchains, these efficiencies that we've talked about here. We saw massive cost savings from using public blockchains for these transaction records as part of a transfer agency system versus our legacy monolithic centralized database systems. If we're seeing that, I'm confident that all of the industry is going to see a better construct in these new ecosystems going forward. So migration to that will happen, but you have to have some sort of way where these crypto exchange businesses can more favorably migrate into the securities related businesses, or the securities related businesses themselves begin to move into these digital asset ecosystems. And I actually think that there's going to be a lot of, I think we're going to see a lot of very large scale corporate development in that space in the next several months and years. It wouldn't surprise me that you would see brand name financial institutions begin to cobble up where they could some of more of these infrastructures that exist in the crypto native space in order to pull plant forward about the opportunities to get to this market size.
Agreed. And Mitchell, from your perspective.
I agree with you. My challenge, similar to your challenge generically, but my challenge is trying to convince large legacy, huge oil companies to change, or at least to adopt, blockchain. Oil companies are, they're having, they're very profitable, and the leadership is legacy. Why change? I mean, they're super profitable. Why do anything different than just drilling and producing oil? And my challenge is to convince their traders that they can trade with crypto people, crypto traders, and make money by doing market making and arbitrage. If I can convince the traders on the desk, who all are making very large bonuses, to work with me, then hopefully I'll make a dent in that $100 trillion oil market.
Well, one of the things you have going for you is this idea that you're seeing so many of these oil producers throughout the Middle East use their excess natural gas that they had previously just flared away in order to power Bitcoin mining rigs.
Yeah, no,
right?
absolutely.
So from a leadership position within the industry, I mean, if I'm Chevron and if I'm flaring natural gas, why wouldn't I also want to just potentially be able to do that and do the same sort of trade and operate it? So I think those opportunities exist for oil.
No, definitely. Sure. All of the flaring of gas, they've been approached by companies like Crusoe Energy and many others to use that excess energy or energy that's damaging the environment right now by flaring for Bitcoin mining. So that is one inroad, and they're certainly adopting that. But then to go to their core business, which is oil trading, and to make an impact there, they're hesitant because they're saying, well, I don't know, this crypto thing, it could hurt our reputation. It's like when you approach an oil company about crypto, it's like approaching a bank about crypto. They're afraid of the regulation and the compliance. But fortunately, again, although I didn't vote for Trump, Trump is good for the energy business because he's going to encourage energy production. He's going to encourage building new power plants. He's going to encourage power plants for Bitcoin mining and AI data centers. So all that attention to energy is going to be very positive for making change in the oil industry in favor of using blockchain.
Thank you. And then Matt, as an investor, like what do you see as some of the challenges that you're facing?
I'm actually going to take the other side, because why not? I don't think in 5 years we're going to hit 16 trillion, but I don't think we need to hit 16 trillion to make it really impactful. And here's why. I think we should focus about a number, but we should also focus about what you actually tokenize. This is so important. The real use cases, like what actually you put on chain is as important as how much you put on chain. I think today, unfortunately, apart from some large institutions like Franklin Templeton, Fidelity, I have many friends there doing amazing pioneer things in the space. Most of the rest of what people talk about RWA still stayed in what we call the narrative stage of crypto. We haven't really getting out of the bubble to really asking ourselves, what you put on chain, why you putting on chain, where's the demand coming from? If you talk to any founders that we've been talking to, we've been investing in, when I was at Citi, when I was at HiveMind, that working in tokenizations, RWA space, their real struggle is really finding what the asset to put on chain that will drive demand. Because they have to figure out, are we catering this to crypto native people, or are we catering this to institutional people? The demand is different, and depending on what you tokenize, it's gonna be different. Let's be honest, the reason why I think right now the real use cases, I see what people are putting homogeneous large quantity on chain is dollar, which is stablecoin, and T-bills, which Roger mentioned earlier. And actually, one drive the other. The reason why earlier this year there's so much tokenized T-bill on chain was because also people are trying to do yield generating stablecoins and one generating with the other, and also benefiting from a tailwinds that interest rates being very high and interest coming down. And again, I'm pretty sure we'll find other ways to drive adoptions, the demand from there. My point being is, I think for the space to move forward, for us to get to 16 trillion and really say, hey, by putting this on chain, we're really fixing a lot of user applications who propel the financial services moving forward. I think focusing about dollar, treasury, different other currencies is super important because that's relevant with onboarding, on-ramp, off-ramp. But my point is, once you're actually getting these users on-ramped with the wallet, what I mentioned, which is very, very important from a user experience standpoint, and then now what? Like, what are you gonna actually tokenize then that really gonna drive a meaningful difference for efficiency, transparency, data integrity? Like, that something has to be a very large asset class, reasonably homogeneous, but has tons of inefficiency. I think treasury market today, sure, a lot of inefficiencies, but the private credit, the real estate, the mortgages, the private lending, there's just so much more, right? But it's a problem we have had for decades. And there's a reason why we still haven't been able to fix it. So I think we need, again, as I mentioned earlier, legislation, regulations coming out to really giving the founders a chance to do things, not worrying on day one they build a project, then they're already guilty until they prove innocent. That's gonna happen, hopefully, in the US, but also overseas. But after that, I think we need to really thinking about what asset class, financial markets or not, that you're really gonna put on chain, they're gonna drive that 10 times better in efficiencies, not just 10% better. So until we fix that, I think that's gonna be the biggest pain point.
I think that's well said. From an investor standpoint, how do you actually get investors excited about investing in real-world assets and tokenized assets? I mean, maybe Roger and Charles, you can maybe talk through and give us your perspective on this, because it's not the build it and they will come. How do we actually create excitement in this industry?
I think one of the things that that we think about at Franklin Templeton is, where can we improve the opportunity sets, expand the opportunity sets for our clients, large and small. We realize that we don't live in a two-dimensional world of just risk and return. It's a 3D, 4D world. In the future, assessments of investments won't just be based on what the risk and return might be, but there's other utility, there's other maybe impact that you're hoping to get. So there's an entire other plane that is the efficient frontier. It's not a 2D just curvature. And those opportunities of unlocking broader and expansive opportunity sets that allow clients to shift that efficient frontier upward rather than simply just keeping going out the risk spectrum is the great promise. And I think that is, we see those opportunities. There are, whether it's regulatory infrastructure, whether it's homogeneous products that actually market makers will actually make markets on, and liquidity. That's the other thing that's never spoken about. You can develop the exchanges, you can develop the type of asset, but you actually need somebody in between making markets on these things. All of these things that are still future opportunity sets. And really, what really makes me think that the the future of asset management itself right now is at just a super exciting time because of the unlock of a future set of investments that we can offer advice on for our clients and their total portfolio solutions.
Yeah. I mean, on my side, usually the first meeting with potential investors goes very well. Everyone's excited. And then the second is like, okay, but my custodian will not accept this asset. How does it fit my accounting system? And a bunch of very practical questions that needs to be handled manually for the first time for these companies. So from my point of view, the most interesting thing about tokenizing RWAs is that within the same system infrastructure, you will be able to access different natures of assets. And that's something you cannot do today. Today, you need a specific infrastructure for equities, another one for carbon credits, another one for real estate or private credits. Tomorrow, with the same infrastructure, you can hold and trade any kind of assets. And that's, for me, is one of the key drivers from an investor's perspective. Now, if I'm being totally honest, today, the clients that are trading with us on this digital asset form, it's also a way for them to try the systems, to see how it works, to have this kind of blockchain/wallets experience, and to, I would say, open the doors to new opportunities for them, also on the crypto space. Because, I mean, buying a bond issued on Ethereum and buying Ethereum or any kind of ERC20 tokens is basically the same thing from an operational perspective for them. So it's a safe way for them to test the network and the experience.
In terms of oil trading, there are a lot of crypto traders who are basically traders, and they've traded oil and gas before. And trading oil in a crypto form is a lot more efficient than trading in futures or trading in physical. So this gives this will give crypto traders an ability to diversify their portfolio to also trade oil in their portfolio.
Right, well, so our time is up, but just one quick question, lightning round, public or private?
I think both has a space in this, depending on the use case again. I think you need a public ledger, just like internet, everybody needs the same TCP IP protocol to connect each other. Like you have to have the public infrastructure. It's like a highway, but then you can have the stations, right? Connecting with the highway that is permission-based, and then you can have different type of user cases where you prioritizing privacy and other stuff that matters more for the asset class. So